Tonight, the silver market split in two. On one screen, the price looks calm, controllable, normal. On the other side of the planet, the same metal trades like it's already scarce. Two prices, one story. And if you're only watching the Western quote, you're reading the wrong scoreboard. Because here's what actually happened. The physical bid in Asia has stayed stubbornly higher, while paper liquidity in the West keeps pretending supply is infinite. Metal keeps leaving the Western pipeline, and the buyers aren't collectors. They're nations, factories, and supply chains that can't afford to be late. This is educational. We manage risk. Now watch this. For years, we were trained to think silver has one price. The quote you see, the number you can screenshot, the number everyone argues about. But silver doesn't live on a screen. Silver lives in vaults, warehouses, refineries, and shipping containers. And when the real world starts paying more than the screen is the one that eventually has to move. So why is the Asian price higher? Because they're not buying exposure, they're buying atoms. A lot of the West still treats silver like a trade, a macro bet, a chart pattern, a quick flip. Meanwhile, big buyers treat silver like oxygen. If they don't secure it, the assembly line stops. The phones don't ship, the panels don't get built, the defense components don't get finished, and when production stops, nothing else matters. Not sentiment, not narratives, not the daily candle. That's the first crack in the illusion. Paper is optional. Physical is not. And we can see the behavior shift in the weirdest places. One of the most telling moves isn't a headline. It's a footprint. A sudden chunk of inventory that leaves a delivery system that was built to look deep and liquid. When you see tens of millions of ounces disappear from that ecosystem, you don't ask, is silver bullish? You ask, who needed that metal badly enough to pull it out? And here's the uncomfortable answer. It's probably not one buyer. It's a stack of buyers acting like adults while the market keeps acting like a casino. Think about the incentives. A country sitting on piles of dollars doesn't want more dollars. It wants stuff, hard assets, strategic materials, anything that can't be printed. And silver is the perfect target because the West spent years keeping the official price tame. Cheap in dollar terms, cheap in narrative terms, cheap enough to accumulate quietly. Now the quiet part is ending. We're watching a global race to secure critical materials, and silver is quietly moving into that category. Not because it's shiny, because it's functional. It's one of the best conductors on the periodic table. It's used in solar. It's used in electronics. It's used in advanced hardware most people never see. And as the world electrifies everything, silver doesn't get replaced easily. You can thrift it at the edges. You can redesign around it sometimes, but you can't cheat the physics. So the bid rises where the factories are. And when the bid rises there, it creates a trap for the West. Here's the mechanism nobody wants to say out loud. Arbitrage. If a trader can buy metal priced off the Western quote and deliver into a market that pays more, they pocket the spread. It looks like free money. But it's also a one-way valve. Every ounce that leaves to satisfy the higher physical bid doesn't come back just because the paper market found support. It's gone, consumed, stockpiled, turned into product, or locked away. That's why the spread matters more than the headline price. The spread is the pressure gauge, and when that gauge stays elevated, it's telling us the paper quote isn't clearing the real market. It's just clearing paper. Now let's talk about the part that gets almost no airtime. Disintermediation. In normal times, big industrial users buy downstream. They let banks and brokers do the sourcing. In stressed times, they stop outsourcing survival. They go upstream. They go to the mine. They go to the pre-refined stage. They go to the sludge and the bars that aren't even finished metal yet. Why would anyone do that? Because finished supply is the bottleneck. And if you're a major manufacturer, you don't care if the metal is ugly, you care if it arrives. So the smart players don't wait for perfect bars and polished rounds. They secure doré, they secure concentrate, they secure whatever can be converted into usable silver with enough refining capacity. And yes, that sounds extreme, until you realize a top producer flying halfway around the world to buy semi-processed metal is a behavior pattern, a signal, the market saying, we don't trust the normal channels anymore. If the supply chain is healthy, nobody pays extra to take the long way. If the supply chain is tight, they pay anything to avoid being last. Now watch what happens when this behavior collides with the Western price structure. And we've got a paper market that can quote infinite ounces without moving a single truck. And we've got a physical market that needs ounces with serial numbers, weight, and delivery dates. When physical demand climbs, the paper system can absorb it for a while, until metal has to leave to satisfy delivery, settlement, or back-end sourcing. And that's where the two prices story becomes dangerous. Because once enough metal exits, the paper price becomes a performance. It looks real, but it's missing the inventory that makes a price credible. You don't need a conspiracy to understand this. You just need basic plumbing. Here's the plumbing problem. Refiners. Refiners sit in the middle of the river. They buy semi-processed material, convert it into deliverable metal, then sell it onward. But while that silver is in process, they're holding a big pile of value exposed to price movement. So they hedge. They short paper against their long physical in process. That's normal. But now imagine silver jumps fast. $2, $3, $5. Not over a year, over days. What happens to the refiner's hedge? Margin calls. And margin calls don't care that your silver is literally sitting in a vat, not yet in bar form. The exchange says, post cash now. If the refiner has $50 million worth of silver in process and the market rips higher, the paper hedge bleeds immediately. The refiner needs cash immediately. If they have it, fine. If they don't, they stop taking new business. And if enough refiners pause at the same time, you don't just get higher prices. You get delays. You get product gaps. You get dealers quoting call for availability. You get premiums that refuse to drop even when the screen price dips. Have you noticed that? The quote falls, but the real-world price you can actually buy doesn't fall with it. That's not a mystery. That's a system under stress. Now add one more layer. Given good. This is the upside-down rule of shortages. In most markets, higher price kills demand. In a strategic market, higher price can create more demand because the buyers aren't buying for profit. They're buying to avoid failure. When supply feels infinite, companies procrastinate. When supply feels finite, they panic. So as the price rises, procurement teams don't say, let's wait for a pullback. They say, get it now before it's worse. That's how you get a feedback loop, not because people are greedy, because people are afraid. And the scariest part is that this loop doesn't start with retail. It starts with industrial. A coin buyer can choose to wait. A factory can't. That's why we need to watch the behavior of big buyers, not the mood of small ones. And the list of big buyers is getting longer. Look at the map of accumulation. In the Gulf, sovereign buyers have used huge paper vehicles just to reach the delivery door, then leaned forward and said, we'll take the bars. In South Asia, import volumes have stayed heavy year after year, like someone is stacking a reserve quietly off camera. In China, buyers have shown up in producer nations and purchased semi-refined output before it even becomes finished silver, paying up just to secure flow. And when major powers openly talk about adding silver to strategic stockpiles, that is a policy signal, not a marketing slogan. Europe has already labeled silver critical for modern industry, and export controls on key inputs keep tightening elsewhere. None of this screams plenty. It screams secure it while you still can. This is how shortages begin, not with empty shelves, but with quiet rerouting. Metal that used to circulate gets parked. The moment the last easy bar is spoken for, the screen price becomes a lagging indicator for us. We've heard public language from governments about building strategic stockpiles of critical materials. We've seen regions classify silver as critical for technology supply chains. We've watched export controls tighten on certain inputs. We've seen an accelerating push to rebuild supply chains inside friendly jurisdictions. All of that points in one direction. Silver is being treated less like a commodity and more like infrastructure. And infrastructure demand is ruthless. It doesn't care about your thesis. It cares about tonnage. So what does this mean for us? It means we stop arguing about spot, like it's the whole truth. We start tracking where the metal is flowing. Because the flow tells you who is desperate. And desperation is the best predictor of price change. Now here's the twist. The market can hide stress for a long time until it can't. Paper markets are great at smoothing reality. They can keep a lid on a pot that's boiling. They can vent pressure through leverage and settlement games. They can make scarcity look like a chart pattern. But physical markets have a hard limit. Delivery. You can't deliver a promise. You deliver metal. And when the metal is spoken for, the price becomes whatever clears the last available ounce. That's why we're watching a global split. One side quotes, one side takes, one side trades contracts, one side trades containers. And if you want to know which side sets the future, ask yourself a simple question. When a solar factory needs silver paste, do they pay with a chart? Or do they pay with money and take the metal? Now notice how the story gets sold. In the West, the conversation stays comfortably abstract. ETFs, flows, rates, speculators, positioning, all of it keeps you in a spreadsheet. Meanwhile, the real buyers are operating like a battlefield. They're securing supply at the pre-production stage. They're paying up. They're building relationships upstream. They're treating metal like a component, not an asset class. And that's why the most important number isn't the headline price. It's the premium. It's the spread between where paper clears and where physical clears. Because that spread is the receipt. It proves someone is willing to pay more right now to get the same ounce. So let's put a flashlight on that spread. In Asia, the physical exchange often closes with a price that's a couple dollars higher than the Western benchmark, day after day, a pattern. Why would that happen if silver is abundant? It wouldn't. If silver were overflowing, you'd see the opposite. Local discounts, easy sourcing, sleepy premiums. Instead, you see an invitation. Send it here. We'll pay more. That invitation is bait for arbitrage. And the arbitrage is a siphon. It pulls metal out of the Western system. And every ounce pulled is one less ounce available to satisfy the next wave. So here's the next clue. Watch the vault reports and inventory changes, not because the numbers are perfect, but because direction matters. When large amounts leave, somebody is converting paper access into real ownership. And if that somebody is an industrial giant, they don't care about being polite. They'll take what they need. Here's where we need to be careful with language. Fact, the physical premium in Asia has been persistently higher than the Western quote. Fact, metal has been leaving Western delivery pipelines in noticeable chunks. Fact, upstream sourcing is increasing, buyers going directly to semi-processed supply. Interpretation, the market is moving from available to allocated. Interpretation, the paper quote is becoming less representative of the clearing price for real metal. Possible risk. If the squeeze accelerates, governments may prioritize industrial allocation over retail access. Now, do you see why the two prices idea matters? It's not just an interesting chart, it's a warning. Because when the split widens, it tells us we're moving into a world where price discovery migrates to the place that takes delivery, the place that pays for metal, not promises. And once that migration becomes obvious, the move can be violent. Not because silver is magical, because the system is fragile. Think of it like a dam. Paper is the dam. Physical demand is the inflow, inventory is the wall, and premiums are the cracks. So what do we do with this? We stop being spectators. We start reading the footprints. When premiums stay elevated where delivery matters, when inventories keep sliding out of the usual channels, when more buyers start bypassing middlemen and reaching straight for supply at the source, those are not vibes. Those are stress signals. If those signals keep flashing, the odds rise that the official quote is lagging the real market. And when the quote snaps to catch up, it won't ask for permission. Now, I want to hit a common mistake people make right here. They wait for confirmation on the screen. They say, when silver breaks out, then I'll pay attention. But the breakout is the confirmation that the cheap phase is over. The smart money doesn't wait for the fireworks. It positions before the crowd understands why the fireworks are inevitable. That doesn't mean we gamble, we measure, we size risk, we keep our head. But we also don't let a hypnotic screen convince us the physical world isn't tightening, because the physical world doesn't care what the screen says. If you're a manufacturer and your next shipment is late, you don't say, but spot is down. You say, find supply, today. And that is the engine of the next move. Now, I want you to notice another trap. People assume the shift to digital money makes metals less relevant. That's backwards. The more money becomes faster and more trackable, the more valuable it becomes to hold something outside that system. And silver sits in a strange sweet spot, monetary in the mind, industrial in reality, strategic in the future. The combination creates demand that hits from two directions at once, and when that happens, the market doesn't break politely, it breaks suddenly. So here's the question we should all be asking. If the West keeps offering cheap paper silver, and the East keeps paying up for physical, how long before the West runs out of metal to deliver? And if we're wrong, where will it show first? Will it show in exploding lease rates? Will it show in longer delivery times? Will it show in refiners refusing new orders? Will it show in premiums that detach completely from spot? We don't need to predict the exact trigger. We just need to recognize the setup. Two prices can't last forever. Eventually, one price wins. Either the physical premium collapses because supply floods the market, or the paper price rises because the metal is gone. So which one is more likely in a world electrifying everything, weaponizing supply chains, and stockpiling strategic materials? That's the real bet. Now, one last angle, because it confuses a lot of people. When a large buyer uses a pooled vehicle to access silver and then stands for delivery, they're basically saying, we don't want exposure, we want bars. That move is not about trading, it's about extraction. It's about converting a financial wrapper into a physical asset and removing it from the public float. And when that happens repeatedly, it changes the game because it shrinks the available pool without sounding like a shortage. It's stealth accumulation. And stealth accumulation is how smart money moves. It doesn't announce, it drains. Now, imagine this behavior spreads. Imagine more sovereign buyers do it. Imagine more industrial giants do it. Imagine more nations decide silver is too important to leave to the market. That's when two prices becomes no price. Because you can't buy what isn't for sale. So here's our stance. We stay calm. We stay curious. We track the flows. We respect risk. And we refuse to be hypnotized by a single number that might be clearing paper while the real market clears higher somewhere else. If this is making you rethink how you watch silver, hit subscribe. Short and simple. Stay with us. And I want to hear from you in the comments. Do you think the real price of silver is being discovered in physical delivery markets now? And if the squeeze accelerates, what do you think breaks first? Refining capacity, vault inventories, or industrial supply contracts? Because the next phase won't be announced on TV. It will show up in logistics, it will show up in spreads, it will show up in who is willing to pay more today for the exact same ounce. And when you see that, you'll know the truth. Silver doesn't have one price. Silver has two, until it doesn't.